These macroeconomic charts will truly blow your mind. We are living in extremely interesting times. What happened last week was that Jackson Hole, Jerome Powell came out and spoke hawkish. They are not stopping interest rates. They're going to leave the pressure on until inflation goes away. That is the worst possible scenario for markets, because markets are addicted to cheap money. So let's take a look at the first chart showing where we are at in this tightening cycle. You can see the bottom left-hand corner is as of March 2022 compared to the rest. It is the sharpest tightening cycle in US history. Compare it to the brown line, which preceded the global financial crisis of 2008 and 9. Compare that to the yellow line, which preceded the tech bubble collapse, and it is the scariest, sharpest one. And there is absolutely no sign of the Federal Reserve letting up. That's what they just told us. Now, if you look historically and you just buy when the Fed is buying the market, meaning lowering rates, and you sell when the Federal Reserve is selling the market, meaning raising rates, you would have done extremely well, because every single time this happens, something breaks and a crisis happens. So let's dig into the data to see what is going on beneath the surface because of all this tightening. So this is the 6-month change in new single-family home sales. Right now, we are way below the single-family home sales in the depths of the financial crisis. Please let that sink in. I'm talking about the mortgage crisis, the real estate collapse in 2008. That is how weak our housing market is. This is the 6-month change in new single-family home sales. And so it goes to speak how destructive the Fed's current tightening policy is. Look at the change in the home buyer mortgage payments. It is literally almost doubled since the Fed started tightening. That becomes unaffordable very quickly because salaries have not doubled. So the same pool of people trying to buy houses are vying for the same houses, but at double the cost. So they become unaffordable. This chart shows the monthly supply of new houses in the United States. So massive amounts of inventory are flooding the market. And so whenever this happens, you get a recession, which is in the dark gray line. So we haven't even seen the worst of it. So you have the entire housing real estate market absolutely collapsing in the early stages of a meltdown. That is a huge deal. Stocks are going to be affected the same way. You saw that meltdown on Friday after the Jackson Hole meeting. And so it's pretty obvious what's going to happen. But again, the market is used to sell-offs where the Federal Reserve can just come in and quickly save it, like in the pandemic low of 2020. Is it different this time? That is the most important question. And it is absolutely different this time because we haven't had out of control inflation like this in decades. And so look at this chart showing the CPI year over year in white. CPI measures inflation, and then you have the Federal Reserve's target rate in yellow. The target rate always needs to be near CPI. It just always does historically. This goes way back 50 years. The yellow line has to be at or near the white line. That is the Federal Reserve's mission. They came out and said it on Jackson Hole on Friday. It crashed markets. They want that yellow line to be at or near the CPI so they can kill it. And so their hope is that they can crash the market, soften the economy, weaken inflation, and just at the right time have that soft landing pivot where they can come in and save the market. And so that is why the question of whether or not the Federal Reserve actually has the tools to save this market is all based on inflation. Because if inflation is stickier, like we've been talking about, the Federal Reserve's hands will be tied and they're going to have to collapse this market for a lot longer. And that's where the scariness sets in. That's what most people are not realizing, because again, the peak inflation narrative has been floating around. So let's look at the underlying data per usual. How sticky is inflation? I don't care if it peaked. How sticky is it? If it's at 7%, for the next year, that is absolutely destructive. And the Federal Reserve can't pivot in that environment. So we have this chart showing just last week, spiking natural gas prices, which is causing fertilizer prices to spike, which is causing agriculture to spike. It doesn't look like inflation has peaked. It looks like commodities are starting to spike. So let's take a deeper dive into what is going on around the world. We have this chart showing household bills in the UK, where they are projected to be. We are talking about a tripling of projected household energy costs from mid-21 to the second half of 2023. And you can see that wholesale energy costs in gray is the absolute primary driver. So energy really matters. Look at the futures for German baseload power. This is no joke. January 23, I've showed you this chart before. It looks familiar, but that line just keeps going vertical. There is an absolute energy crisis going on. And the reason why this is important, again, seems like a lot of Americans are saying, oh, this is isolated to Germany, right? There isn't contagion. We've heard that before. The reason why that is important is because the European Union makes up 25% of S&P 500 earnings. So if your utility bills go up 10x, which is what is being projected by these high energy forecasts, then your ability to spend on anything goes down and you enter a severe depression. And so again, if you're Europe and you make up 25% of the US S&P 500 earnings, it matters. And so we can already see what is happening because of this energy crisis. Here's visible aluminum inventories crashing even further than where they've been in the past. They're halting production because energy prices are too high. And so when energy prices get too high, things shut down. The market can't sustain it. And so I would argue that there's contagion happening. The US, this chart shows US suppliers shipping out the most natural gas to Europe on record. So this shows total exports, volume of exports. Right now, we are at an all-time high in what we've been shipping to Europe. And so because of this, Biden administration warns of action to address U.S. fuel exports. The Biden administration is warning refiners that it may take emergency measures to address fuel exports as stockpiles of gasoline and diesel fuels remain near historically low levels in the Northeast. We're preparing for a winter when an energy crisis could happen in the Northeast. Contagion. Energy contagion. While East Coast gasoline and diesel inventories are well below normal, exports of U.S. refined products are at an all-time high. Not a good look for the United States when we are depleting our energy. Europe's in dire need. What if the Biden administration does take emergency action, slows the amount of natural gas resources sent to Europe? Well, the energy crisis in Europe is going to get even worse. And it's hard to say whether or not the US is going to be able to compensate and be ready in a cold winter. But this tells me that the leadership is worried about natural gas inventories right now. We know they've already been depleting the national stockpiles throughout this crisis. Well, what happens if there's a supply crunch here? And so again, energy is the most important input to inflation. This looks like it's going to be stickier than anyone realizes. Now let's look at both sides of the equation. Obviously, we have to be objective here. There is an argument that Europe is doing just fine. We just saw the massive outflow from US natural gas. The US is the Saudi Arabia of natural gas. We have 200 years worth of supply in the ground. Now, it might take more time to get it out of the ground than people realize. And in a crashing economy like ours, where we need Federal Reserve stimulus, we need it out of the ground yesterday instead of today. Well, you could argue that with that huge outflow to Europe, that Europe's going to be absolutely fine, because look at natural gas inventories in Europe. They're at an 80% target in orange, and you can see the current capacity. So this is the holdings by country. And so what you can see here is that due to the massive exports, Germany is at its 80% target currently. Again, showing you all sides. This is what the opposite side is saying, that the market doesn't realize how much inventory Germany actually has on hand. Well, given this information, you would expect that futures curve to be a lot lower than where it is. But the futures curve is factoring in a scary winter, because this is absolutely a different time where Russia has cut off future supplies. And what if the US cuts off future supplies of natural gas? Well, that's why this is different. So you might want to be higher than your 80% target. And so the opposite viewpoint to this is EU gas consumption has been lower than normal currently. That's why they were able to keep and meet that 80% target. So you can see in Red, the gas consumption has been low. So thankfully, even though Russia has cut off supplies to Europe, gas consumption has been low. They've been able to meet the target. Well, what do you think happens in the winter when that goes up and there isn't enough to replace and meet that target? This comes from Alessio. The gas consumption has been lower than normal. Countries have been using coal to produce electricity, and the price of gas has skyrocketed based on this speculation. If Russia cuts off all supply via Nord Stream 1, the price will skyrocket even more. So there's a lot of unknowns. Putin has his finger on the entire European market, and he could plunge the entire European continent into darkness. America is already worried. And so this whole presentation has just been to point out that inflation may absolutely be stickier than people realize. There are major energy problems potentially on the horizon. And so this is all in the context of what the Federal Reserve is doing, which is hiking interest rates and absolutely obliterating financial markets. They are not dovish. We need dovishness to pump. Right now, we are not pumping. We are crashing, and we're going to continue to crash until the Federal Reserve comes and does a dovish pivot, which it seems like their hands are tied at the moment. And so we have this chart showing the S&P 500 index currently compared to the S&P 500 index price action from 2008, before the financial crisis. Looks like it's making pretty much the exact same pattern. I love looking at charts like this because the psychology behind price action remains the same. People are manipulated the exact same way. You do have bear market pumps just like we're seeing now. And the question is, will we roll over? If you believe that you should be selling when the Fed is selling and the Federal Reserve is aggressively selling, you could foresee a potential massive down move in stocks ahead, and we will stay on top of this market. Again, my favorite positioning is just a nice hedge on your portfolio so that you can protect it against the short-term downside and raise capital in the meantime. I hope you guys enjoy this content and enjoy looking through these charts. It is absolutely incredible what is going on in the markets right now, and we'll stay on top of this market. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.